Tonight, we're tackling one of the most important parts of an investor pitch, the numbers. If you can show that you know your numbers well and that you don't shy away from the financial management of your business, your potential investor will know that you take your role as the leader of your business seriously. Do I hear you saying, "But yes, I'm not an accountant. I don't understand complicated numbers. Surely I can just outsource this to a finance professional." Well, no, you can't. You can absolutely outsource your bookkeeping, but managing your finances is another matter completely. You, as the owner, must always be on top of your numbers. Remember, ultimately, you are responsible for all the taxes and legislative requirements relating to your business's finances. Now, I have to confess that I also once hated the numbers, but there is a simple way to approach them. All you're doing really is telling the investor the financial story of your business. Your story starts with your projections. We recommend a 3-year projection plan that includes budget and cash flow projections. Each year in your plan should have a worst case, best case, and most likely case scenario. If you're already trading, you also need your latest financials so your investor can compare what's happened in the past to what you say will happen in the future. This provides them with a sense of how credible you are, as well as how you approach the financial management of your business. So, what does an investor look for? Basically, they want you to answer 5 questions so they can understand how you make money. The first question is, what are the levers for making money in your business? In other words, what are the key drivers for your business to make money? What must happen for your sales and production volumes to be enough to make a profit? Secondly, your investor wants to know about your key costs. What must get paid in order for your business to keep running? And what are the biggest costs you need to keep your eyes on? Thirdly, where is your value created? This is a key driver of your sales and ultimately your profits. Remember, your customer determines your value. They will only pay a price they believe is equivalent to the value your product creates. Fourth, your investor wants to know your pricing strategy, which is a fundamental strategic decision in every business. How do you price? Why have you selected that strategy? And how does your pricing compare to your competitors? Lastly, your investor wants to know about your hidden costs. They will do the research about your industry. If there are possible costs that may creep up, you should disclose them. Now, I know most entrepreneurs aren't fans of financial ratios, but what I've learned by looking at them from an entrepreneurial perspective is that they can actually be your best friends. Most accounting software can calculate ratios for you, but you do need to know what they mean to understand how they affect your business. By using the 4 ratios I'm going to tell you about in conjunction with your projections, you'll be able to make adjustments before a possible future problem becomes a definite present crisis. The first ratio is your gross profit margin. This tells your investor the value your customer gets from what your business does. Without value, your customer won't pay you much above your costs, and this will reduce your gross profit margin. Which brings me to ratio number 2, your net profit margin, or the bottom line. Many entrepreneurs try to manipulate these numbers because they think an investor won't invest in a business that's making a loss. But actually, most business people expect a loss, particularly in the first few months and in low seasons. Realistic numbers are going to impress an investor more than big numbers. The third ratio is your break-even point. This is when your business makes enough to pay all its expenses, including the costs of sales, but not enough to make a profit. You can calculate this either as revenue or as units sold. This ratio is important because it's a reality check for your margins and sales projections. Lower margins make it harder for you to break even. Finally, your investor obviously wants to know how much they can expect to make or their return on investment. Investors don't generally invest out of altruism. Even if they do, they'll be reassured that you won't need another investment later down the line if you can show that you are financially stable enough to predict a good return on investment. And that's it. Your accounting software will do all the calculations, so all you need to do is tell the story of what they mean. That's the end of this 4th learning session. See you in the next one. Goodbye.